Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Well, exactly a month ago on March 1st, Apollo Management Chief Economist Torsten Slok came out with a note that said the following. The reality is that the U.S. economy is simply not slowing down, and the Fed pivot has provided a strong tailwind to growth since December. As a result, the Fed will not cut rates this year, and rates are going to stay higher for longer. Carol, you'll remember he came on our program that day and he made his case. Now here we are a month later.
Yeah, and we've had a Fed meeting, received a slew of economic data, and by many measures, the economy is still very strong. Just this morning, we talked about this earlier with Mike and Ira, learned that U.S. manufacturing activity expanded for the first time since 2022, and the odds of a June rate cut have dipped below 50%. So people seem to be coming around increasingly to Torsten Slok's view, Tim.
Yeah, we've got him back with us. Torsten Slok, Chief Economist and Partner at Apollo Global Management. He joins us from New York City.
We want your crystal ball. That's what we want.
Well, that's what we want is we want to check in a month later and see if your view has changed at all or if your view has been reinforced, Torsten, that we're not going to see a rate cut at all in 2024.
No, I know this is radio, but I'm smiling here because I think exactly that the data is moving the way of this view. We have seen a very substantial easing in financial conditions since the November 1 FOMC meeting. If you look at the market cap of the S&P 500, which is in very round numbers, at the moment around 45 trillion. We have seen a 25% increase in the market cap of the S&P 500. That means about a 11 trillion increase in the value of the stock market. Think about it over 5 months, and combining that with the bond market also going up $2.5 trillion because rates are lower, credit spreads are tighter. That's adding $13.5 trillion in wealth to the household sector. It's just really difficult to argue that this is not going to be a significant tailwind to consumer spending, to capex spending. And combined with the IPO markets picking up, M&A activity picking up, and the stock market rallying, and of course the credit market also rallying, it's just really difficult to see that this is not going to give a very significant tailwind to GDP growth over the coming quarters.
So sticking to no rate cuts. And what I'm curious, Torsten, and Mike McKee here at Bloomberg mentioned that the Fed is not convinced that they'll get to 2% if they cut rates now. If they, if that becomes kind of their thinking and they stay with that for the rest of the year, or do you think that that's what's going to happen for the rest of the year, that we're going to kind of not quite get there, and so the Fed is just going to have to kind of sit and wait and be patient?
Exactly, Carol, because if you look at the data that came out last Friday from PCE inflation, you're beginning to see both in PCE inflation and in CPI inflation. If you take the 3-month annualized change and the 6-month annualized change, and why would you look at the 3 and 6 month annualized change? Because it tells you something about momentum in the economy. Is the momentum accelerating? Is the momentum decelerating? And the reality is, when you look at that both for PCE inflation and for core CPI inflation, you're seeing a pickup in inflation over the last 3 months and 6 months. And that clearly tells you that the Fed, we are just not there yet. And in particular with the Fed pivot, remember also that the Fed pivot was so substantial because it came on the back of literally 18 months where everyone had been sitting on the fence and where everyone had been hearing the Fed saying rates are going higher, 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 higher. And suddenly the Fed said, well, now rates are going lower. Everyone jumped down from the fence and began to take risk. That's why capital markets have reopened. That's why risky assets have rallied. So I think that the tailwind, this was not intended necessarily by the Fed, but the tailwind that's been coming along over the last 4 or 5 months is just very, very significant.
Do you think maybe sooner rather than later that the Fed is going to start kind of dropping the idea of any rate cuts? I mean, when does the Fed start to shift the narrative? Because markets don't like to be shocked. You know that we have a Fed that probably doesn't like to shock the markets either. And I just, we had Waller, right? Chris Waller coming out of the Fed saying the Fed should delay or reduce cuts after some of the recent data points. So when is the narrative already starting to shift, do you feel, or I don't know, what?
Well, it definitely changed. I mean, just a few months ago, the market was pricing that we will get 6 cuts this year.
But that was the market. That wasn't the Fed, right? The Fed's dot plot said something different. So
the Fed was saying 3.
Right.
Fair enough. The Fed was saying 3 all along, but now the market is on 3. And as you know, if I look at my Bloomberg screen here, pricing for June is now 50-50, whether they might even cut in June. So I still think that this tailwind is being underestimated literally by everyone in the consensus community. We are going to see strong non-farm payrolls on Friday. We'll get, the expectation is 205,000, and the expectation from the consensus from ECFC Go on my Bloomberg screen is that the unemployment rate will go down from 3.9 to 3.8. It's a really difficult environment for the Fed to talk about rate cuts when you have such strong data. Also, ISM earlier today, as you both know, came out very strongly. Now we have suddenly an expansion for the first time since 2022. We also see now suddenly that prices paid in ISM also beginning to accelerate. So all things combined, jobless claims, ISM, non-farm payrolls, CPI for the last 2 months, it all points towards the economy is just not slowing down, and the tailwind from easy financial conditions continues to provide quite a support.
Okay, Torsten, let's say that you're correct in this analysis. Indeed, we don't get any rate cuts this year. Is the market right now, both the equity market and the bond market, are they missing this? And what happens when they realize, in your opinion, that this will happen? What kind of sell-off do we see?
Well, I think that the first place that, of course, this will begin to show up is in rates and also in credit markets, that all-in yields are going to stay elevated for the next several quarters because we just need more of a slowdown, and it's just not possible for the Fed to do that if they begin to cut rates. So I think that the first stop will be for the market to begin to realize that rates are not going to come down as quickly. The next step is the debate that you are having, of course, so well also in the previous hour here, namely about, okay, but what does that then mean for the stock market? In the S&P 500, it used to be the things were the Magnificent Seven. Well, now that's being trimmed down because some of the Magnificent Seven are turning out to be less magnificent.
Yeah, we've been talking Magnificent Four and the two others.
Now suddenly, you should also be always be on alert when the nomenclature and the wording starts to change around. Hey, it's no longer 7, now it's only 4. What's going on? And maybe one very important backdrop for this is that if rates are higher for longer, highly levered companies with low coverage ratios, with weak cash flows, are going to continue to be vulnerable. In particular, tech, growth, venture capital, some parts of healthcare continue to be very sensitive to rates staying higher for longer. And this will begin to bite harder and harder on the equity market. So I do think that the downside risks to equities are beginning to become more substantial as a result of this view that rates are going to stay higher for longer.
Does it feel like you're lonely in this view, or you're less lonely than you were a month ago?
He wants to know, what do your friends say when they see you, or your friends at Apollo and say, come on, Torsten.
A month ago, I probably had fewer friends than I have today, but I do feel that the friends here on the dance floor are coming over to me and coming around to the view that maybe we are seeing more evidence that the economy is not slowing down. And I do think that this idea and this view, as I just highlighted, that the stock market going up so much is a very significant boost to consumer spending. And if you add also crypto prices also going up, you have a marginal propensity to consume out of crypto wealth that is estimated to be double of the marginal propensity to consume out of equity wealth. So the tailwind to consumer spend is just really strong at the moment. And as long as the stock market wants to continue to go up, we should all be positioned for the consumer still doing really well.
Well, and the consumer's done better, right? Because wages have gone up, and that has certainly helped them. But I do think about, higher rates and what it means for buying a house. That slows things. We talked about it with autos, right? That slows auto sales. Those are some big, consumer purchases. And housing market, right, trickles down in a lot of different ways. You buy a house and you have to do a lot of stuff to put in it and do around it. I mean, so I am curious, Torsten, remind us what economic metric that you focus on that kind of, or a couple of them, whether it's a basket, that says, okay, the economy continues to do really well.
That's really important, Carol, because if you just back up for 1 minute and think about when the Fed raises interest rates, it has a negative impact on those who have debt, those households who have debt, those companies that have debt, and for that matter, even those banks that have debt. So therefore, when rates go up, what happens is what the textbook would have predicted, namely highly levered households that are highly indebted, which tends to be younger households. They generally tend to be going more into distress and therefore seeing delinquency rates going up on credit cards, on auto loans, having bigger challenges buying a house. Likewise for firms, those firms that are being impacted by rate hikes are those who have a lot of debt, highly indebted companies with low coverage ratios, with weak or no cash flows, are of course also those that the textbook would have predicted that are most vulnerable. But at the other side of the scale, you have the IG firms that have plenty of cash. You have high and middle income households that have plenty of cash and assets that have gone up in value, they have so far seen a significant boost as a result of asset prices going up. They have not seen the negative effect of interest rates going up. So there is a bifurcation to your question about who is being negatively impacted. Are those who owe money? Those who are being positively impacted are those who own assets.
So so I totally get it, understand it, right? You got to look at the market in different ways. 30 seconds left here. So is there something you, though, focus on specifically that either gives you confidence in your thinking that the Fed's not going to cut rates at all this year? What is it, or what do you think investors should be focusing on in terms of a metric?
Yes, so I would say the dual mandate, of course, number one is inflation. And the second thing is, to your question, of course, number two is the labor market. So the net effect so far of these challenges for those who owe money, and on the other hand, the benefits for those who have assets, the net effect has still been a strong labor market. So if the labor market starts to slow down, then we will begin to change our view. But that's obviously not what we're seeing. That's not what consensus expects for Friday.
Right. And as you said, reminding us that we do get a big one, the monthly jobs report on Friday. Torsten, thank you so much. So glad we could check in with you again. Torsten Slok, he's Chief Economist and Partner over at Apollo Global Management, joining us right here in New York City.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Tesla. Last year, it was the top performer in the S&P 500. This year, it is the worst performer. It was a top performer, I should say, last year, not the, but nonetheless did really well last year. This year, it's the worst performer so far in 2024. Shares are trading down just about 1.7% here as Wall Street is worried about a key metric for the company, and as the company hikes prices in one key market and as another price increase in another key market takes effect. So, Tim, there's a lot going on.
Yeah, with more on Tesla, all things Tesla, back with us, one of the co-hosts of Bloomberg Technology on Bloomberg TV, Ed Ludlow. He's not on the West Coast today. He's here in our Bloomberg studio. Ed.
Hello.
Hello. Welcome. Welcome back.
For having me.
Hey, before we talk big picture Tesla, I think we got to just address the elephant in the room here.
Sure. What's that?
Which is that you now have a different view of Tesla, or perhaps a more nuanced view of Tesla, thanks to a recent lease.
So last week on Thursday, I picked up a Tesla Model Y. I was one of the people to take the deal, and I leased it. And I leased it because my wife and I needed a new car. Our existing lease is up for renewal, and I had tried in 2020 to get a Model Y, but it was too expensive. I couldn't afford it. And you'll remember, because of the chip crisis, it was a 6 to 8 month wait. And this time, there was just heavy incentive, the full federal tax credit. Tesla's own incentives were about $7,000, and they threw in 5,000 miles of charging. So I think anyone would be foolish to have passed that up if they were in the market for an EV.
So just so we understand, because the people go through this each and every day, the pros and cons of buying a fully electric vehicle versus an ICE vehicle. What was the tipping point for you?
It was the lease price. So I decided to lease because of the cash flow. Basically, it's basically $300 a month, which is very competitive, in the leasing landscape, even against
cheaper than parking in New York.
Wait, $300 a month?
For the lease, yes.
Wow.
Now, you have to put some money down up front, but when you take into account the economics of charging, either at Supercharger or at home, it's significantly less. If to fill up my gas car was about $80, to fully charge the Tesla is about $10. So, it's very interesting.
Did you definitely want to do an EV?
Yes, I definitely did.
So you were looking at the EV market
not just because
widely.
EVs are cool, or because I am a journalist. I cover Tesla for what it's worth. I do not have Tesla shares or stock, but I wanted an EV because the economics in my mind made sense.
But it didn't have to be a Tesla EV. You were looking more broadly.
I put this in a post on X. We looked at all kinds of EVs that were eligible and not eligible for the federal tax credit, the lease price. Buying or financing was not an option. Why? Because rates are really high right now.
Right.
So anyway, I did that last week, and the story, big picture with Tesla, is they always do heavy discounts and incentives the final few days of a quarter. Why? So that they can sprint finish and boost those numbers.
This is where deliveries. Being a journalist that covers Tesla is helpful, right? Because you kind of know the cycles within the company. All right, broaden out. So that's your story. Broaden out, though, for the company overall, because the stock's under some pressure on concerns about the delivery numbers.
We're worried about this quarter. So the average estimate of all the analysts that Bloomberg tracks say that Tesla will deliver around 449,000 vehicles. That would represent a sequential decline of from the end of 2024, the fourth quarter to 2023 to the first quarter of 2024. The number you really want to look at is whether it's above or below 422,000. Why? Because that's the number of EVs they delivered in the first quarter of 2023 a year ago.
Okay.
And it's been a long time since Tesla's registered year-on-year sales declines. That would be pretty bad. But it also speaks to where Tesla's at in its evolution as a company and where the market for EVs is.
Where the EV market is.
Yeah.
Well, what's a bigger story? Is the bigger story the EV market or specific to Tesla?
It depends on your point of view. If you're a Tesla shareholder, you're hoping that Tesla exceeds expectations and does really well. Tesla and Elon Musk talk about being between two waves. Their big boom was built on first Model 3 and Model Y. But there is an argument that all of the people that were in the market for an approximately $40,000 to $50,000 EV have been and gone. You know that the future is this next gen EV from Tesla that's $25,000, but that's a year at least away, if not more. $25,000 price point would unlock, particularly in North America, a big addressable market for them. But they're kind of caught in limbo between the two.
Well, speaking of a $25,000 or much less, go to China, right? Where there are definitely EV makers who are offering up some very inexpensive options here. The other story that's certainly out there on the Bloomberg is about what's going on in Tesla China. Specifically, they did price hikes.
Yeah, and they did it in the US as well.
And they went into effect.
That's actually really important. So Tesla offered a lot of incentives at the end of the quarter. In my case, they offered free supercharging, but a heavy discount on the lease price. But they have said for many weeks that they were always going to raise prices on April 1st. The timing is interesting because, as you know, some of the domestic players are doubling down and continuing to cut prices.
Right.
And it's much more aggressive in China. But it goes back to your question about is this a Tesla story or a bigger story about EVs? One thing that North America does not have is the same options that the Chinese market has. There are more companies offering all kinds of types of EV. Here, we only have a few, let's be honest. And many of those aren't even eligible for federal incentives.
So why would he raise prices in China?
Because it's his blanket policy globally. They said, look, at the end of the first quarter, everything is pretty discounted.
It's everywhere.
Yeah.
But is that about signaling to the market that the price hikes are done? So don't wait any longer to buy a Tesla?
I think, I've learned never to try and guess what Elon Musk-led company will or won't do. What I would say is that, to their credit, Tesla's been relatively consistent on using prices as a lever. In other words, they've raised prices as often as they've cut them and vice versa. Whereas if you think about what happened when Tesla first started cutting prices, everyone had to catch up. So Ford and GM started cutting prices, but Tesla was leading the market, so they could raise them back up again.
It's actually an interesting strategy. If you think about it, it's like a share price. Like, all right, do I think it's going to go up?
Right,
do I think it's going to go down? And he keeps kind of keeping you on your toes in terms of what might come next, right?
Yeah,
it feels that way a little bit.
The wild card last quarter in North America was what Dana and I reported on, which was if you order a new Tesla now, Elon Musk is ordering all staff to give you a demo of the full self-driving technology.
What is that about? Yeah,
I think it's the idea that, do you guys know take rate, the word take rate?
Yeah.
That many people, if they're demoed, they're offered full self-driving, they usually don't follow through with it. So if you actually show them before you hand over the keys, so to speak, they might actually go through and buy it.
Yeah.
Remind us, $12,000, $13,000?
It's $12,000 or $199 a month as a subscription. And what's interesting, when I picked up my Model Y, I wasn't demoed it. They just handed over the key card, so to speak, and off I went.
So you don't have full self-driving?
No,
you could have gotten it if you wanted to.
But
is it ready for prime time?
I, as a consumer, not as a journalist, I think I would be okay with using it. But I just decided I didn't need it. I quite enjoy the experience of driving the Tesla, so I'd rather do it myself.
But is it a risky strategy going back to China when there are so many other EV makers, or does Tesla put itself in kind of like a cachet area and saying this is kind of the upscale EV? I don't know.
So the average selling price, the ASP of both Model Y and Model 3 is relatively low right now in China, as it is here relative to its historic price. Basically Model Y was more expensive a year ago, if you put it in really simple terms. So Tesla's kind of found its market. It's the kind of American brand, name recognition, tech leading premium EV. It's not a mass market EV. China offers all. You find that historically Mercedes has done really well there. Why? It's a status symbol to drive a Mercedes, and that's extended to battery electric. They also sell budget, super cheap, no frills EVs, and there's a market for that in China too. Tesla sits in the middle, and the question is, what's left in that market to buy?
Hey, Ed, I want to go back to something that you mentioned a few minutes ago. It was this idea of a $25,000 Tesla. We talked to Dana about this on Thursday. And it's this idea of an unboxed approach, a sort of modular approach
like
to
Legos.
Building a vehicle, like Legos, but also not at all like what Henry Ford developed for the assembly line. Is there a chance that Tesla can actually pull this off?
Yeah.
I mean, this is a revolutionary approach to building a car.
It is, and it was explained in that now infamous PowerPoint presentation. But this is a like classic Elon playbook. And actually, we should stop talking about Elon. There are many talented, capable people at the helm of Tesla who do this, where you focus on shaving pennies or cents off each individual component. Remember when the Model 3 was first brought into production, it was made of many different metal panels, and somebody in Tesla, maybe it was Elon, decided this is so dumb. Why are we doing all these different welds and nuts and screws with individual panels? Why don't we just stamp one big piece of metal, dramatically altering the cost of production and the end product? And what Dana writes about in that brilliant piece from the 28th is exactly that. They go to each individual component, simplify how each component's built, vertical integration and all this stuff, and the net result is a much cheaper car. You have to engineer your way to 25,000.
Like if you change the model, right? Essentially, the financial picture of that model can change dramatically, and that's what he seems to kind of tick away at.
Yeah, the problem is that, you know, we talk about it as journalists that are interested, or as a Tesla owner, or as a consumer. Yeah. The investors are the ones with little patience, and so that will be a good test of patience, like whether this thing they're promising us comes as quick as they say.
Right, and as we said, the stock has been under a lot of pressure this year. It's down, let me just pull it up here, down about 30% so far in 2024. So nice to have you on this coast for a while, so thank you so much. We'll try and maybe grab you again later in the week. Co-host of Bloomberg Technology, as you know, on Bloomberg Television, Ed Ludlow joining us here in our studio.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, Vita Coco is one of the top players in the coconut water market. It's a space that's been shared by some brands that you definitely know of, PepsiCo and the Coca-Cola Company and a few others, Tim. And North America has definitely been a dominant market for this drink specifically.
Yeah, in the U.S. alone, the coconut water market size is projected to surpass $18.5 billion by 2031, growing at a compound annual growth rate of nearly 19%. With a look at the market and more, let's get to the interview with Mike Kirban, co-founder and executive chair at the Vita Coco Company, joining us from New York City. Mike, good to have you with us this afternoon. Earnings came out late February, reported net sales for the fourth quarter that beat the average analyst estimate, the stock soaring nearly 15% on that news. I do want to take a step back and talk big picture here about the marketplace, growth, consumer demand. Where are you seeing demand right now in the category?
Yeah, thanks for having me. So coconut water is the fastest growing category in the beverage aisle today. 20 years after we started building this category from scratch. It is one of the largest beverage categories across the tropical world. And now over the last 20 years, we've been building it in North America and Western Europe. And we're seeing coconut water become a household staple across these markets. And we think that as we continue to grow and continue to educate consumers on the benefits and usage occasions for coconut water, we think it will continue to become a household staple in both North America and Western Europe and all the other markets where we're continuing to build our business.
Hey, North America, as we talked about, has been a dominant market for the drink. Talk to us a little bit about if that's kind of where you see the continued growth, or how you find and tap into other markets, where you see future growth in particular. And who do you see as your kind of typical buyer, if there is one?
Yeah, so North America continues to be our largest market and continues to grow incredibly fast. Today, we're in 1 in 10 households in the United States. If you think about other similar type of categories, Ocean Spray is a brand that I like to reference quite a bit. Cranberry juice, Ocean Spray is in 4 in 10 households across North America. So, this is something, as we think about coconut water, which has all these incredible usage occasions. It's incredibly hydrating, drink as a sport drink or replenishment, but it's also amazing in a cocktail and it's amazing in a smoothie in the morning. So it has all these incredible occasions for usage. And we think that as we continue to grow, more and more households will continue to come into the category.
Curious about the cost side of the equation here, and specifically where the ingredients come from. Where do the coconuts that you guys use come from?
So I actually just got back yesterday from Sri Lanka. We manufacture quite a bit in Southeast Asia, Sri Lanka, Philippines, Thailand, and also Brazil is also a large center for our production.
Any problems that you guys have seen with kind of some of the challenges or wars, I should say, around the world? Is that impacting you guys at all?
We saw, freight costs increased a little bit with the issues around the Suez Canal, but that's been moderating, and we've been able to, continue to, withstand that and grow our margins, and we don't see that as a major issue for us moving forward.
The animal rights organization PETA has raised issues about monkeys being forced to harvest coconuts in some parts of the world. Has that been something that you've experienced at all when you've been traveling?
No,
and you've been sourcing these?
I've never seen a monkey pick a coconut. This is something that does happen in Thailand in a tourist attraction, but is not something that is used in typical coconut farming techniques. We cracked over 1 billion coconuts last year to produce our coconut water, and none of them were picked by monkeys.
But how do you ensure, Mike, and we certainly have from just reporting in the business world and financial world, that when you get into emerging economies, sometimes oversight is not always what it needs to be. How do you ensure that everything that goes into a Vita Coco drink, that it is done in a sustainable and caring way and fair way?
Yeah, it's one of the most important parts of our business, actually. Over the last many years, we've built through the Vita Coco project. We've done incredible things on the ground. In the Philippines, for example, we've built over 40 schools. We're educating farmers specifically on new techniques and bringing them new types of coconut trees to improve their yield and increase their income. So we do a lot of work on the ground. We also do social audits of all of our facilities, making sure that everything is done in the best way possible. And I think this is one of the beauties of the business. Is we've been able to create this business off of what historically was a byproduct of the coconut manufacturing business. The water has always been a byproduct. We've been able to help upcycle that byproduct, give these markets, these farmers an avenue to sell the product, and at the same time put programs together to continue to develop help develop these economies. So that's been one of the most rewarding things for me. Yes.
Mike, how have you been able to innovate in the production of this? I'm curious about ways that over the last 2 decades that you've been able to experiment with cutting costs. Are there ways to make this a concentrated product and then add water to it once it's at its final destination? Are there ways to create a fountain drink out of this? Talk to me about innovation here.
Yeah, so as we think about cost, it's scale. Right. So coconut water, like I mentioned, was historically a byproduct. It's about the actual packaging and process of packaging that is costly. But over time, the more scale we get, the more we're able to leverage that scale and bring down costs. As we think about innovations and so on, we're really focused these days on more sizes, more pack types, more flavors, and expanding shelf space. I brought up Ocean Spray earlier. When you think about it, we built this business over the last 20 years selling single-serve individual, Vita Cocos on the shelf. We would have 2, 3, 4, 5 facings at a grocery store. Today, over the last couple of years, we've been introducing new pack types and new formats with 12 packs and 4 packs and 6 packs and 1 liters and multi-packs of 1 liters. But we're starting to build out that billboard on shelf. And if you think about that compared to Ocean Spray, which has 4 times the shelf space we have, that's kind of something that we're working towards, is continuing to create this billboard at retail for consumers to see coconut water as they're walking down the aisle.
Hey, Mike, for someone who's been doing this for 20 years, started back in 2004, as you continue your build out and look to do, more growth in the North American market and elsewhere, I'm just curious, do you plan to continue to do it alone? You're a publicly held company, I get it, but I'm sure you've had people knocking on your door. Is there a plan? At one point, Coca-Cola owned a brand, then obviously it was sold back to its creator. But I'm just curious, is there any plans, or are you open? Is there a partner or a price that would make sense for your brand to get together with someone else?
we have a great partnership with Keurig Dr. Pepper. They're our largest distributor in North America, and they're a small shareholder, but they're really a great distribution partner. So we feel we've got the right partnerships and resources, and we generate a lot of cash, and we feel we're in a really good position to continue to invest in growth, and that is our main priority today.
So is that a no?
Yeah, for now it's a no. It's we could grow this business significantly with the setup that we currently have.
Well, really cool stuff, and look forward to talking with you again as you guys continue on that growth path. Mike, thank you so much. Mike Kirban, he's co-founder, executive chair of the Vita Coco Company, joining us right here on Bloomberg Businessweek.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Why am I hungry? You're the one who's always hungry.
I don't know why you're hungry.
I'm starving.
Well, it's because, it's almost 4 o'clock, Carol.
It's 4 o'clock. It's time for dinner time. It's not time for dinner time. It's like 3 hours early.
Okay, we talk a lot about food, but we also talk a lot about AI.
Yeah.
And our Bloomberg News team has written a bit about stock picking using AI. They didn't have much success doing it.
No.
Eric Jackson, though, is doing just that. He's using an AI algorithm to pick stocks and manage his portfolio. You know Eric Jackson is the founder and president of EMJ Capital. He joins us from Toronto for our Drive to the Close. Eric, good to have you with us. How are you?
I'm great. How are you guys?
Yeah, we're doing well. Thanks for joining us. Eager to talk about how you're using AI for your portfolio. Talk to us. Like, what are you doing? Are you just using ChatGPT? Did you write something? Give us all the details.
No, ChatGPT we use in the actual construction of the programming that goes into studying the different range of factors that we look at, which are typically, all the big technical ones that you would expect. And in fact, like over 100 technical indicators that we look at. But then fundamental factors, company-specific factors. We also look at things like Google Trends data. We look at stock sales, stock purchase information, and basically try to look at how each individual stock, weights all those range of factors differently. So what matters to an Apple is different than what might matter to a small cap stock. So I have a tech focus, so I'm only looking at a universe of about 300 names from around the globe. Most of them trade in the US. But you're basically trying to search, find that needle in the haystack, the perfect weighting of all these different factors, what matters most to the stock when, so you can get in and then get out just in the nick of time. It's tricky and it's difficult, and it does take a lot of work, and there are a lot of off-ramps for ways that you can fail, but some promising ways that we've found success so far.
Well, that's what I was curious about. How successful is it? Like, is there a percentage, 50% of the time, 60% of the time it kind of works?
It varies. Typically it's greater than 50%, but the hit rate in terms of which of the trades, matter most, that are making money, I should say, you're typically easily beating a 50% benchmark, which doesn't sound like much, but the trick is really you make the money on the winners, and the winners stick with, and they can go on and on and on. And so a name like Meta, for example, has been along in the portfolio for the AI model that we use since last October, and it's gone up, considerably. NVIDIA has been along since last December. So the trick is, can you get out of the failing trades quick and stick with the winner? So even if you're at a 50% hit rate, your mean return per trade can still be quite high,
right?
If you are sticking with those winners.
Do you factor out though something, I'm just thinking if you're doing Google searches, and I guess it depends on what the Google search is, but when there's a stock in the news, we find just momentum of information on it just rises. That doesn't necessarily mean that's a good thing, but I just wonder, how do you take that into account, or how do you factor that in or out, or balance it out?
Yeah, it'll probably get recognized, Carol, through one of the technical indicators like, moving average and whether, a stock is remaining above its moving average over a period of time. A second wave of buyers comes in. A move in the name like NVIDIA last year from 100 to 500, I think was more just institutional buying, and people kind of getting in on the great May results and then what came after that. But I think the move we've seen since then, since 500 to almost 1,000 where we are currently, NVIDIA's almost replaced Tesla as kind of the new retail darling. But regardless, it's healthily stayed above certain key moving averages, which has caused it to remain along in our portfolio.
All right, enough of the macro. We appreciate you talking. Yeah, we got to talk some specifics.
Yeah, I was really surprised to see how exposed you were to crypto right now. MicroStrategy. What's so appealing to you about crypto?
I don't like most of the miners. I think the miners, have their own issues, and there are kind of rumors that come and go about, their power consumption and whether they're going to be taxed more for energy usage and all this kind of stuff. So if you're just looking at equities as a way of exposing yourself to saying you're bullish on crypto and you think that Bitcoin is going to continue to go higher, other than just buying one of the new Bitcoin ETFs, I think the two best ways are through Coinbase and through MicroStrategy. Now, MicroStrategy, I think it was last week, got a short attack from, I think it was Carousdale, saying that nothing nefarious is going on, but they just think it's too overvalued relative to how much Bitcoin it holds. It's now got over 200,000, I think it's 211,000 Bitcoin on its balance sheet. And so if you work out the value of those Bitcoin relative to its smaller digital business, it seems overvalued, according to Carousdale. I think, they've been wrong about a few picks that I'm long in my portfolio. Kirban is probably the biggest one for the last 6 months, where they've been short since 30, and it's now, I think, almost 90. So I just kind of brush that aside. I say, Bitcoin is now basically a digital gold play in my eyes. There are only so many Bitcoins that are going to be out there. Certainly, everybody. But why not just buy
Bitcoin instead of buying equities related to Bitcoin?
Because it's a more levered play on Bitcoin. So if you believe in the short term that crypto is going to remain strong, Bitcoin's going to move up. Let's say, Tim, let's say you and I believe it's going to move up 10 to 15% over the next couple of months. I think MicroStrategy is going to end up doing something like 30% over that time period. So I would rather have exposure there.
Interesting.
Sana Biotechnology. Can I just throw one more out?
Yeah.
I don't know. Is that Sana? Am I saying it correctly, Eric?
Yeah, that's a smaller cap biotech name. Basically, one of the three themes that I like within tech: biotech, crypto, and not surprisingly, AI. And so within biotech, I play it through holding the ETF XBI. Yeah, that's sort of like a more equal weighted exposure to a broad range of names. And then I have some individual plays like Viking Therapeutics that did really well a couple of weeks ago, and then Sana, which is it's done well this year, but it still has some big announcements, I hope, in front of it this year, especially in the area of type 1 diabetes, especially, and some other projects.
Gotta run. Yeah, Viking up 325%, Viking Therapeutics. Eric Jackson, really fun. Thank you. Founder and president, EMJ Capital. This is Bloomberg.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.